meltdown in the rupee.
The rupee slipped to its weakest level ever.
The currency of India is nosediving compared to the US dollar.
Let's talk about the rupee because it's hit a new low of 89.49 to the dollar.
Today, the rupee dropped below 91 to the US dollar, meaning one US dollar was worth 91 Indian rupees, and that is a historic low.
The rupee is falling. The noise has begun. But does that mean trouble? Let's step back and see what a currency really represents. Every few months, a new headline appears. The rupee has hit a new record low against the dollar. Numbers have kept changing over the years. There have been like 82, 85, and the recent 90. But the reaction has been the same. There is panic, there is worry, and a sense that something has gone wrong. We treat the exchange rate like a scorecard, like as if the stronger currency is winning and that country prevails, and the weaker currency is losing. That feels natural, but it is misleading. What does a falling currency actually mean? Is it a sign of economic weakness? Currency can fall due to various reasons. Some bad, some neutral, and some even intentional. And unless we understand why the rupee is falling, the number alone is going to tell us very little. So next time, when the headline pulls us into a panic, it's worth asking a better question. What's really happening beneath the surface? Alright, so before we jump into why currencies rise and fall, it's very important to go over some concepts that will make us understand the rest of the video much easier. Because here's what happens. People see like one number, USD INR, and then they try to explain it with one sentence, like imports are high, oil is expensive, investors are selling, inflation is rising. While each one of them is true, none of them tells us the whole story. So instead of collecting like these random explanations, it's very important to have a simple mental model that we can build, something that we can go over in our head again and again. And to build that model, we need like 3 ideas. Not the complete reasoning, just these 3 simple ideas to help us understand the fall. So let's start with inflation because that's the most real. Inflation is just rising of prices over time. The same thing costing more rupees than they used to be. And we don't need economics background to notice it. Think about it in ordinary life. A plate of something we would have casually ordered, or a cab that you would have taken a zillion times, a movie ticket, grocery, and a basic meal outside. If over the years the default price of everyday life goes up, that's inflation. Now, here's the key reason why inflation matters as a concept. It changes what the rupee can buy inside India. It's not that the prices went up, it's just that the rupee's purchasing power is slowly drifting. And this matters because currencies in a deep sense are comparisons. They're not just numbers, they're comparisons of values across countries. And inflation is one of the biggest things that changes a value from the inside. So keep this mental note. Inflation is like a background noise and it changes the meaning of money over time. So the next thing we should talk about are interest rates. Now, interest rates are one of those things that are going to sound abstract until you have had an EMI. Because the moment interest rates changes, it changes your real life. Like if the rates are going up, borrowing gets expensive, loan feels heavier, monthly payments change. But if it's going down, borrowing gets easier, people are buying more things, businesses expand, and the economy booms. So how do interest rate connect to inflation? Now here's a very simple rule. When the inflation is high, interest rates are going to be higher too. Why? Because if the prices are rising very quickly, one of the common ways to cool the economy off is to make borrowing more expensive and saving more rewarding. It's like turning down a dial that slows the pace of spending in the economy. So if you remember just this one direction, high inflation generally leads to higher interest rates, not always immediately, not perfectly, but it's like a very common pattern that's seen across economies. So now we have like these two pieces. That is inflation that changes the value of money over time, and interest rates. That is like a dial that moves along with inflation. Okay, now the final piece, which is demand and supply. Because in the end, an exchange rate is just a price, and prices move when the pressure of buying and selling change. Now, the only twist with currencies is that every buy is also a sell. So if you're buying dollars, we are automatically selling rupees, and if at the same time, if you're buying rupees, you're automatically selling dollars. So let's consider an example where an Indian company needs to pay $1,000 for something. Maybe it's a component, it's paying for software or buying a machinery or whatever. That company goes to the currency market and says, I need dollars. But to buy those dollars, what does it use? Rupees. So that one action does two things at the same time. It increases the demand for dollars because someone is trying to buy dollars, and it increases the supply of rupees because of those rupees are being sold in the market to get the dollars. So currency movement is not mysterious, it is literally a balancing act. So if, for example, more people are trying to buy dollars using rupees than the other way around, then the dollars become harder to get and $1 costs more rupees. If overall more people are trying to buy rupees using dollars, then rupees becomes more difficult to get and rupees strengthens. When we increase the demand of one currency, we simultaneously increase the supply of the other. And that's why exchange rates are two-sided. Now that we have a basic mental model in place, let's zoom in on inflation. And more specifically, how differences in inflation across countries slowly push the exchange rates around. Let's start with a simple stable world. Assume the exchange rate is $1 that equals to 80 rupees. And it's been like that for a while. No drama, no headlines. Now imagine inflation over the next year, how that looks like. In US, the price rise is about 2% and in India, it's about 6%. So far, nothing unusual. Fast-growing economies often have higher inflation rate. And here's a really important part. At first, the exchange rate does not change. $1 is still 80 rupees. And that delay matters a lot. Inflation doesn't announce itself through exchange rate first. It shows up quietly in prices. Let's make this concrete. Suppose there's a product, say a simple manufactured item, and that costs $10 in US and 800 rupees in India. At an exchange rate of 80 rupees for $1, those prices are going to be exactly the same. Perfect balance. Now imagine inflation kicks in, and after 1 year, the US prices rise about 2%, so that will make the $10 product roughly $10.2. In India, price rise will be like 6%, and that 800 product rupees will become like 848 rupees. So far, this feels like domestic inflation, but now comes the key step. Convert that Indian price back into dollars at the same old exchange rate. So your 848 rupees will be divided by 80, which is about $10.6. And suddenly, something subtle but powerful has happened. The same kind of product now costs 10.2 in US dollars and $10.6 if sourced from India. Nothing about the quality has changed. Nothing about productivity changed. No one suddenly became worse off at producing things. Prices just drifted apart. And for buyers, especially large buyers like importers, global companies, that difference matters. If you're choosing where to source your goods from, you start leaning away from the more expensive option. So demand for Indian exporters will soften a bit. And at the same time, Indian buyers find the foreign goods relatively cheaper than before. So demand for dollars increases, demand for rupees weakens. No panic, no sudden crush, just a perfect imbalance. And when demand for currency rises related to supply, its price goes up. And when demand weakens, its price drifts down. And that's how rupee starts to fall. Not overnight, not in one dramatic candle on a chart, but slowly, month after month, until prices line up again. As the rupee weakens, that 848 rupees product no longer converts to $10.6. At a slightly weaker exchange rate, it comes back to $10.2. Trades becomes balanced again, purchasing power realigns, and that is the key insight. Inflation doesn't crash currencies. It creates a steady pressure. Exchange rates move not to punish countries, but to quietly restore fairness. So inflation is like a slow force pushing on the system, and exchange rate is the adjustment mechanism. And here's one final piece to keep in mind. Inflation explains the direction, why the pressure builds, but it doesn't fully explain the speed. Some currencies adjust faster, some resist for longer, some move smoothly, others in bursts. And that timing, how fast or how slow exchange rates respond, is where the next force comes in. And that force is interest rates. And that's what we'll look into next. So think of interest rate as a reward for holding a currency. If inflation is slowly pushing the system out of balance, interest rates decide how long people are willing to wait before they start reacting. Interest rate incentivizes people to keep money in their account rather than taking out. Now let's go back to the same old world where $1 was equal to 80 rupees. US inflation is lower, India's inflation is higher, and now imagine you are a global investor. You don't care about patriotism, you don't care about purchasing power parity. You are constantly asking one simple question. If I hold my money in this currency for a year, will it gain any value or quietly lose value? Higher inflation means money loses value faster. So countries with higher inflation usually respond by offering higher interest rates, not as a bonus, but as a compensation. It's basically the economy saying, yes, prices are going to be rising faster here, but we'll pay you more for staying. So let's say interest rates look like this. In US, rates are around 3%, and in India, rates are around 7%. Now notice what this does. Earlier, inflation alone was pushing people away from the rupee, but the high interest rates pulls them back. Suddenly, holding rupee isn't obviously bad anymore. Yes, prices are rising faster, but you are also earning more by just holding Indian assets. The government bonds, bank deposits, business investments, all of these are rupees based. So instead of everyone immediately selling rupees, they will invest more. They wait, they rebalance slowly. So here's a clean mental model to carry forward. Inflation decides where the exchange rate wants to go. Interest rates decide how fast it gets there and how smooth or bumpy the journey is going to be. No drama, no mystery, just incentives, flowing money, and gradual adjustment. And once you see exchange rates this way, as outcomes of pressure and compensation, headlines start to lose their power. They're just snapshots of much larger process quietly playing out underneath. Now let's bring everything all together using the simple idea of all, demand and supply, because in the end an exchange rate is just the price, and prices move only when buying pressure and selling pressure change. With currencies, this is especially clean because every transaction is an exchange. If someone sells dollars and buys rupees at the same time, so the moment the preferences shift slightly, the balances start to move. Think first about investors because their decisions tend to show up early. When investors feel confident about an economy, when policies are predictable, infrastructure supports growth, regulations are stable, taxes make sense, institutions are trusted, they're perfectly happy holding money in that country. They buy government bonds, fund companies, build factories, and finance long-term projects, and every of those actions begins with buying the local currencies. That steady demand supports the exchange rate. But when confidence weakens because government feels shaky, policies change suddenly, regulations become confusing, or long-term planning feels risky, something subtle happens. Investors don't necessarily panic or rush for the exit, but they hesitate. New investments slow down, existing capitals look for safer alternatives, and incremental money starts flowing elsewhere. That hesitation matters. Fewer people buying the currency combined with few more selling it is enough to shift the demand and supply over time. And the exchange rate begins to adjust downward, not because of fear, but because of incentives and that they had changed. Now zoom out from the investors to the broader economy, because currencies are shaped by millions of everyday actions. As incomes rise and living standards improve, consumption patterns change naturally. People buy more foreign goods, better phones, imported electronics, foreign cars, overseas services, and businesses import more machinery, technology, and specialized equipment to support their growth. And here's the key point: none of these things are paid for in rupees. An iPhone, a German car, or advanced industrial equipment ultimately has to be paid in the foreign currency, which means someone somewhere must go to the currency market and buy dollars or euros first. If an economy demand for foreign currency grows faster than its ability to earn foreign currency through exports, that gap shows up directly in the currency market as the demand for foreign currency increases and the higher supply of the local one. So when you put everything together, the picture becomes surprisingly clean. Inflation slowly changes the relative prices and trade competitiveness. Interest rate influence how long investors are willing to wait and how smoothly the adjustments happen. Confidence, governance, and consumption patterns decide whether people want to hold the currency or move away from it. No single headline causes a currency to rise or fall. No single data point explains the movement. Exchange rates are simply the outcomes of millions of decisions made by consumers, businesses, investors, and policymakers, all interacting at once. Once you start seeing exchange rates this way, the chart stops feeling chaotic or scary. They start to make logical explanations, not perfectly predictable in timing, but understandable in direction. And that, more than anything else, is the mental model that matters.